Hello everyone, today's topic is little more complex than normal, but this is how wealthy people say taxes. I just want everyone to understand this. What people do normally is this. We have two buckets, right? Non-passive and passive income. Normally what they're doing is they're trying to convert their passive income and losses into non-passive and offsetting their non-passive income. So non-passive incomes could be W-2, capital gain, dividend, and they want to convert their passive losses, especially to real estate, into non-passive. But that's not how most wealthy people do. We have this real estate professional status. We have circumvented loophole. If you just focus on real estate, you take those losses, try to convert them into non-passive through material participation or meeting a rep status, and then offset your W-2 income. But wealthy people out there is not trying to just do a short-term rental or qualify as reps every single year. Think about Trump, okay, or Biden. Doesn't really matter which party you are. They are not out there trying to log their hours and qualify as a professional. What they're doing is they're converting everything into passive business. So let me show you how it's done. I'm going to share my screen with some notes so you can understand better. These are guides available online. Please go and download them if you want to read them. So this is what normal people do. Non-passive tax planning, right? What they try to offset their active income with real estate. And how it's done, they use cost segregation, and then they want to qualify as reps or use a short-term rental loophole. Two ways, right? And then they use the loss to offset the income, and those income could be W-2 or business profit or anything you can think of, right? Now, why is this not a good strategy for the long term? So if you look here, what's the problem with this non-passive strategy? It requires annual requalification. It requires significant time and documentation. Also, IRS isn't like this is one of the highest audited areas. And then it really requires your personal involvement, so you really cannot grow that much. So that's typical non-passive planning strategy. So what we're trying to show you today is how rich people do it. They're not out there trying to qualify as reps or trying to do short-term rental every single year. It's a good strategy, but you don't have to do that all the time. As you grow your wealth, as you grow into your businesses, this is how you should think. So this is our alternative strategy. Real estate is always passive. If you don't qualify as real estate professional or your short-term rental is not materially participating activity, right? So let's say you just buy a property, have a full-time property manager manage the property, unless most wealthy people do. They're not going and managing their own properties. So you're going to buy real estate, but you're going to convert all your other business activities into passive. That's called reverse passive tax planning. Why it works? You can pause and read through this. These guides are available online, but only passive losses can offset passive income. By converting your other business activities into passive, what you're doing is you're taking these passive losses without huge work of converting it to non-passive via rep status and a short-term rental loophole and offsetting each other, just like most wealthy people do. So pause this and read through this. All you have to do is keep your real estate passive. Don't maturely participate, don't qualify as reps. Have someone else manage them. Every other thing you get involved in your business as you grow, make it passive. You can use them through a limited partnership, or invest in other syndications, or use them in private equity funds, right? And then, boom, use them to offset each other. It's that simple. This is how most rich people do. I know I went very fast, and this is a complicated strategy, but if you understand it, it's very simple. All you have to do is not follow what everyone is doing. It's okay if you're starting out as a real estate investor, but as you grow your wealth or as you grow your portfolio and you invest in other people's business, because that's what most rich people do. You take your real estate losses, you take the passive business that you're involved in and offset each other without rep status, without short-term rental loophole. I hope that's helpful. We'll see you in another video.